So I had a couple of queries there lately from people about UK investment trusts. And the reason why people are starting to get interested in UK investment trusts is that they have a cheaper tax rate than ETFs, which we know the profits of are taxed at 41%, and you have the deemed disposal rule. So people are starting to get attracted towards UK investment trusts because they are taxed at the lower rate of 33% CGT. But really, should you be just basing your whole decision on what is a good investment or not based on what the tax is on the profits? I want to try and explain another point of view that maybe you should consider, especially when you are deciding between both of these options, because most people, they're just looking for a simple passive fund like the S&P 500, but they want it to be tax efficient. But by going this route of getting into a UK investment trust, are you actually better off or worse off? So I'm going to have a little bit of a thought experiment here, if you bear with me for a couple of minutes. What a lot of people do not take into account is that these UK investment trusts, they are more often not actively managed. So in this case, they have investment managers that are here trying to beat the market. They're getting paid to try and beat something like the S&P 500 on a consistent basis, which more often than not they will not achieve over a long period of time. And because these investment trusts have actually a lot of staff and analysts, their fees are quite hefty compared to a regular passive fund. So if we compare the typical fees, you can get investment trusts with fees, annual fees, this is of zero point 0.8 up as far as 2%. So these are fees that are charged annually on your total amount invested, which is quite a lot. If you compare that to a regular S&P 500 ETF, the fees could be as low as 0.07%. So there is quite a big disparity in the fees, and that can add up over time. So what I wanted to do is just to show you how much these fees can add up over time. I'm going to show you just a few different scenarios and see what you think. So let me just take you through some of the assumptions that I have used for these three scenarios that I'm going to take you through. For scenario one, my assumption is going to be that both funds actually grow at the same rate at 8% per year, just so we can do a comparison of how the taxes work versus the fees over time. We're going to assume also this investor puts €3,000 each year into the fund. And for the first example, they're going to sell all of their investments after 5 years. The fees that we're using for the ETFs is 0.07%. And for the investment trust, then we're going to assume fees of 1.5%. So in our first scenario, after 5 years, taking into account also things such as your exemption that you would get under capital gains tax, deemed disposal doesn't come into it here because it's under 8 years. So after 5 years, putting €3,000 in each year, if you had invested in an investment trust, you would come out with profit after tax of €2,311. And then for the equivalent ETF, you would have come out with slightly less at €2,075 after tax. So you would be €237 better off with the trust. But as we will see in a moment, as the time horizons actually go out further, this starts to flip. So in scenario 2, we have the exact same assumptions. The only difference here is that instead of selling in year 5, we're now selling in year 10. So similarly, again, both funds are growing at 8% a year. You're investing €3,000 in each, and the fees are the exact same as the previous scenario. So after 10 years, your profit after tax for the investment trust is €8,734, but your profits from the ETF are €9,221. The only difference in tax, I suppose, here is for the trust, you'll pay that tax at year 10, but because of deemed disposal, you'll have to pay a little bit of tax in year 8, a little bit of tax in year 9, and the most of the tax you'll pay then will be in year 10 when you sell all of your investment. So that's the only real difference, but you are better off by €487 in this example by investing in the ETF. The fees that the investment trust actually charge here has a big bearing on the answer. So if we increased it again from 1.5% to 2% over the same timeline, then you're better off by €1,334 by going with the ETF. Obviously, you can find investment trusts with fees that are cheaper than 2% or 1.5%, but you're not always going to be guaranteed as well that it's going to outperform something like the S&P 500 over the long term. More often than not, fund managers will struggle to consistently outperform the S&P 500. So that's just something to bear in mind. So that is why it's important to not just consider what is the most tax efficient investment, but also take into consideration how much are the fees and how much do they actually eat into your profits over the years. And obviously also what can offer you stable and consistent returns.